that, we want to welcome in Eddie Ghabour, Key Advisors Wealth Management, the owner over there. Eddie, thank you so much for joining us, kicking off things this Monday morning. Let's start out with the headline that, initially rattled markets. You've seen futures under pressure. We're off the lows of the session, off of this downgrade from Moody's when it comes to the U.S. credit rating. It's had this sterling credit rating, still from Moody's. It feels like, though, Moody's playing catch up to S&P, which was back in 2011, to Fitch in 2023. What's your take on this and how meaningful it is?
We really don't think it's meaningful at all. To your point, they're just playing catch up. We thought the market would look through this noise. And we actually bought the open this morning to add increased equity exposure. And also, at the end of the day, we just found the timing kind of odd. I mean, they've watched our debt explode to $37 trillion and then finally decide to downgrade the debt. But at the end of the day, from a market standpoint, the most important thing for us to continue to follow, that's more important than what the rating agencies say, is what the bond market is telling us. And the bond market's been increasing on the 10-year, has been showing some strength over the last 3 weeks. So the spike this morning, which we've come down from a little bit, I think was just a reaction to the headlines. At the end of the day, we actually think the economy is going to accelerate from a growth perspective over the next couple of quarters, and that's probably why the bond market has started to show strength over the last 3 weeks. So we'll have to wait and see. And again, if the bond market doesn't go straight to 5%, we're going to be okay. I think we're going to be in this range-bound market in the interest rate environment, and the markets can handle that and will continue to trend in a bullish fashion, in our opinion.
You know, you make a great point. That's what it seems to be spelling right now. When you look at the yield on the 10-year, is certainly not at the same levels that we saw earlier in the session when the news first, or when investors were initially pricing that news, or processing that news, I should say. So it's really about, if we saw the 10-year, the 30-year claiming 5, but if we saw the 10-year at that level, that's when one would be worried.
That's exactly right. I mean, we've seen panic attacks in the bond market when we've started to get closer to that 5% range. And I think investors need to just kind of get grips with this is going to be the new normal. Inflation's going to stay elevated. Yields are going to be where they are. And at the end of the day, a 5% 10-year treasury is not that high. We've just been spoiled with 0% interest rates for over a decade, and that's what's got us in the mess that we're in. So investors need to just get acclaim to this new normal. This is where rates are going to be. This is probably where they're going to stay. And I don't think it's necessarily a bad thing to normalize interest rates.
Okay, so you said you bought the market today. You've taken also various positions. I know this morning you bought into XLY. So you're looking for exposure here, obviously, to consumer discretionary. Why consumer discretionary? I mean, I know that overall it seems like your thesis is that we are going to see some growth, but what if there's slow growth?
So if there's slow growth, as long as it's accelerating from a rate of change perspective, which we think we'll see, the market will reward that. And at the end of the day, if we're wrong on the data, we'll get out of that position. But we're buying areas right now that still have a lot of upside just to break even. These areas have been hit really hard during the sell-off that we've had at the beginning part of this year, and they're just now starting to play catch up. So when we're looking at forward-looking data, we want to get ahead of it and buy things that we think have the most risk-adjusted reward for our clients. And that's an area that's been really hated. And it has Tesla as one of its top holdings. And I think there's a lot of momentum behind that name, which is a reason why we've increased our position there this morning, along with other areas.
Okay. Yes, well, Tesla has certainly started to make something of a recovery, given some of the price action that we saw last week and overall within the Mag 7. Another buy that you had this morning, QQQ, that has, QQQ now positive for the year. What's your view on the balance of the year? Why are you more constructive on it now?
So mega cap tech for us, frankly, is more of a defensive play than what our discretionary buy was. So we thought it was a great compliment. And whether we like it or not, this market can't make new highs without the Mag 7 being one of the leaders. And so, again, there have been areas there that are continuing to show higher lows, higher highs, and continuing to strengthen. And if our thesis is right here, growth accelerating, I think you're going to see these names continue to catch a bid. So it's a great core holding for us, for our clients with the right risk tolerance.
Okay, and it looks like you went out for some exposure on small caps as well. Tell us about that.
Yeah, so this is our biggest. This is one that's out there. That's not our strongest conviction, but it's a contrarian play. Small caps have been hated. We have been hating on them as well too. But when we look at the scope of things, if we're going to be getting trade deals, if we're going to get the 10-year kind of top out and stay range bound, and we start to get acceleration of growth, I think you're going to see small business sentiment start to increase again. And small caps have slowly started to show some strength. So we put a position on today, and we will buy more if we continue to get confirmation that we're going to get growth. And this is an area that we think can generate quite a bit of alpha because it's very under-owned, but we will be quick to cut it if it ends up burning us on the trade.
Okay, understood. The desire to be quick to cut it if necessary, especially given the underperformance when you compare, for instance, to the S&P 500 of IWM. But, you know, if you're right, you're right. And especially to your point about seeking alpha here. But let's talk about your last buying position that you took, SMH. That's a semi exposure there. What's the view there?
So when you go into a full-on risk-on environment like we think has already started here, many times you're going to see the semiconductors lead the way. And the semiconductors were one of the worst performing areas during the crash. We already own NVIDIA for our clients, so we thought the SMH would be a broad-based way to play the semis, because if we're right on growth, I would expect the semis to lead the way much stronger than the Mag 7. And so this, again, is an area that has quite a bit of upside just to break even from its highs of this year. So we thought it was another good entry point to add to the buys that we made last week.
Okay, and then Eddie, I want to just ask you really quickly, going back to kind of what started our conversation. There are analysts that I've heard from that seem to agree with your view with regard to Moody's. It's essentially more bark than bite here. But there's also the view that when we see the momentum that we saw last week, that the market was overbought. Where do you know, in that a negative headline, you kind of needed that essentially to bring things in balance. Do you think that that makes sense?
Absolutely. I mean, you want to see drops and you want to see little small corrections in a bullish trend because it's very healthy. At the end of the day, there are so many people that have been wrong about the economy, beating the recession drum, that this market is under-owned. This is probably one of the most hated snapbacks I've ever seen in my career. And I think this is why there's a floor on how big of a drop we'll see here in the near term, because every time you see these drops, these folks that have been completely underinvested are going to be forced to buy to keep up with the market. And so you got a natural buyer in this market right now on dips. There'll be a point in time when that doesn't work, but until now, I'm going to not fight the tape and continue to ride this momentum to new highs that we think will hit this summer.
Okay, not fight the tape here. All right, that's Eddie Ghabour, Key Advisors Wealth Management. Thank you, Eddie.
Thank you.